The William Bernstein no-brainer portfolio may indeed be a no-brainer. Here we'll check out its components, historical performance, and the best ETFs to use in its construction. So who is William Bernstein? William Bill Bernstein is a retired neurologist, financial theorist, and prolific investing author. Like the other voices of wisdom in the investing world, William Bernstein maintains that index investing is superior to stock picking, and that asset allocation is far more important than the selection of those assets or timing the buying and selling thereof. He delineates the details and reasoning behind this approach in his first book, The Intelligent Asset Allocator. Bernstein is one of the most prolific investing authors out there. Math and theory nerds like me and armchair investors alike will enjoy and get something from all of his investing related books. The Intelligent Asset Allocator, If You Can, How Millennials Can Get Rich Slowly, The 4 Pillars of Investing, Lessons for Building a Winning Portfolio, The Investor's Manifesto, Preparing for Prosperity, Armageddon, and Everything in Between, and Rational Expectations, Asset Allocation for Investing Adults. That last one is more advanced and beginners should probably skip it. So what is the William Bernstein no-brainer portfolio? As the name suggests, the no-brainer portfolio was created by William Bernstein. It is considered a lazy portfolio, being easy to implement and manage. I've also seen it referred to as the simpleton's portfolio, which makes sense as this is arguably the simplest of all the portfolios Bernstein has created. No special asset classes here, and Bernstein admits he is an asset class junkie. He also designed the coward's portfolio. The William Bernstein no-brainer portfolio is a diversified blend of 4 equally weighted asset classes: 1/4 US large cap blend, 1/4 US small cap blend, 1/4 international stocks, and 1/4 short-term bonds. Going back to 1986, here's a comparison of the William Bernstein no-brainer portfolio in the S&P 500 through 2022. Had we invested in the no-brainer portfolio during this time period, we would have ended up with an even lower risk-adjusted return than the plain old S&P 500, so the diversification didn't really do much for us. So what happened? Let's talk about the portfolio's components to figure that out. So we're basically taking a barbell on stocks and excluding mid caps. I don't have a problem with that, just something to note. I like that we're overweighting small caps, but if we're doing that, Bernstein would also know we should probably overweight or tilt small cap value. So I'd rather see small cap value stocks for that piece, which would not be an insignificant switch because they comprise 1/4 of the portfolio. Small cap growth stocks with weak profitability have been shown to not pay a risk premium like small cap value stocks. Also note that global market cap weights put the US at around 55% and international stocks at about 45%. So we're overweighting the US stock market, which for US investors is called home country bias. Most people do this anyway. Again, I don't have a big problem with that, but it's just something to note. I prefer to see a tilt to emerging markets, but I think Bernstein was purposefully trying to keep it simple and have a small number of slices. I can understand that. Simplicity is underrated. The confusing piece and what dragged down the portfolio's performance is the short-term bonds. Just like with his coward's portfolio, Bernstein seems to forget that more volatile assets make better diversifiers. When the portfolio is not bond heavy, here bonds only get 25%, it doesn't make much sense to use short-term bonds. We want the greater volatility of longer duration bonds because it is better able to counteract the downward movement of 75% stocks. This is where I've always fundamentally disagreed with Bernstein. He argues for portfolio efficiency and diversification, but then seems to stop when it comes to the fixed income allocation. He subscribes to that unfortunately widespread mental accounting idea of taking risk on the equities side, meaning he views the short-term bonds myopically as a safe haven for cash, which they are. But this is like covering one eye during a stock market crash, looking at the short-term bonds and saying, well, at least that piece didn't lose money, which is demonstrably irrational. One should always attempt to optimize the portfolio as a whole, not each asset in isolation. The ironic thing is that Bernstein should know this better than anyone, as he's written several books on asset allocation. Moreover, bond duration should ideally be matched to the investor's time horizon. The investor using the no-brainer portfolio clearly doesn't have a 1 to 2 year horizon because it's still 75% stocks. In the interest of full disclosure, I really enjoy Bernstein's writing style and I've gotten great entertainment from his books, but I fundamentally disagree with him on several other points as well. One, he has a weird aversion to ETFs and prefers mutual funds. I assume he just likes to stick with familiarity since he's older, because his reasons cited for this irrational preference hinge on commissions and spreads, which are immaterial concerns in my opinion, particularly with highly liquid funds that we'd be using here anyway. Secondly, he advocates for dollar cost averaging and says that it boosts long-term returns. We know this is demonstrably untrue over the long term. Similarly, he suggests market timing to buy more stocks during downturns. This is easier said than done, but more importantly, it requires holding cash as dry powder on the sidelines, which we also know is suboptimal on average. In fairness, the robust research on these last points came after most of Bernstein's writings. So anyway, back to the bonds. Here's how things would have worked out using long-term treasury Treasury bonds, denoted by LTT in the name. Much better. Note the lower volatility, smaller max drawdown, and greater general and risk-adjusted returns. This is because in using long bonds, we're giving the bonds piece more room to do its job of mitigating stock downturns. Now let's talk about how to build this portfolio using ETFs. We can construct the no-brainer portfolio with the following ETFs: VOO at 25%, SPSM at 25%, VXUS at 25%, and SCHO at 25%. I'll include a link in the description to invest in this portfolio. If you're like me though, you might want to use long-term treasuries like I illustrated earlier. That would look like this: VOO at 25%, SPSM at 25%, VXUS at 25%, and VGLT at 25%. I'll include a link below for this one as well. If you enjoyed this video, be sure to check out my breakdowns of other lazy portfolios here. What do you think of the Bernstein no-brainer portfolio? Let me know in the comments. Thanks for watching.